Friday was also a very interesting day because when I woke up Friday morning, silver was up over $1. Silver was at like $33. I mean, $33, excuse me, $33 and like 30 cents, 40 cents. And so it looked like a real breakout, except the problem was it was only silver. Gold was only up about $4 or $5. So when I saw that, I was, it was a little iffy. And I thought, maybe there's just a lot of unwinding of these spreads because a lot of people, I think, have been long gold and short silver as a spread, thinking that, look, if gold goes down, silver will go down more. And if gold goes up, it's been going up more because the ratio has been moving in that direction. So rather than just being long gold, I'll be long gold and short silver. And in case the market goes down, I can make money that way too. But I think that it's been so stretched where the ratio has been more than 90-1. I was talking about this on the last couple of podcasts. I've been telling people, look, buy silver. And I still think that you should be buying silver over gold right now. Right? Even though I'm a gold bug, silver is really cheap in terms of gold. And so it looked like we were getting a unwinding of that spread. And I think that's what happened. But then as gold started to go down, it cascaded and gold went to down $45 and silver went from up $1.10 to unchanged, right? I think it ended up the day flat. Now, it still was a gain in gold versus silver in recent times. If gold was down $45, silver would have been down $1, maybe more. Instead, it was flat. So I think there was some unwinding going on throughout the day, but that unwind caused gold to go down. People start getting bullish on silver. It's because gold and silver are going up. I think it's a much stronger bull market when you have silver leading the way. And I think maybe we're going to be entering that. So at this point, with silver still trading around $32 and gold, near, it's 2,900, even though it dropped $45, it's still barely below 2,900. In fact, it's up, it's up $13 right now on Sunday night. So it's just $28.95. We're only $5 below 2,900. Silver should already be above $50, given where gold is at a minimum. So for now, I would focus on it. And especially with the tariffs looming, there's been articles written and it's happening. They're not just writing the articles. They're writing about what's going on. But a lot of gold has been coming into the United States, a lot of it coming in from London. And the reason I think you're seeing a rush of import is to get ahead of these tariffs, because the tariffs would apply to gold. And a lot of the gold that Americans might want to buy is going to be imported. America produces gold. We're the fifth largest gold producer in the world. Number one is China, right? They're pretty much number one in everything. Number two is Russia. Number three is Australia. Number four is Canada. And then the United States. If gold demand really picks up, which it should, we won't be able to meet it with our domestic production. And so we're going to need imports. Well, if there's a 25% tariff, who's going to want to pay 25% more for their gold? So the idea is, let's bring the gold into the country now so that we don't have to import it. Well, I would suggest the same thing for our customers at Schiff Gold, right? Don't wait to buy your gold after there's tariffs. That's the worst time to buy it. It's going to be tough. So if you want to have physical possession of gold and silver, buy it now, not only because the price is going to go up, but because the tariffs may go on. And of course, the gold producers are not going to eat those tariffs.
Gold has always been the ultimate store of value, not because its price rises arbitrarily, but because paper currency is consistently losing its purchasing power. The fundamental misunderstanding that many investors have is that they see gold as an asset that goes up when, in reality, it is fiat currency that is going down. This is an incredibly important distinction to make. The more central banks print money, the more it dilutes the purchasing power of every existing unit of currency, making tangible assets like gold and silver more valuable in comparison. Historically, gold has been a hedge against financial instability, but in the modern financial world, many institutions and retail investors fail to grasp the underlying fundamentals that make it so valuable. Instead, they remain focused on stock market trends, technology stocks, and short-term speculative plays. However, in an era where global debt levels have reached unprecedented heights, those same investors will eventually be forced to rethink their strategies. The recent surge in central bank gold purchases is a strong indication that major global players are aware of what's coming and are actively preparing for it. In the West, particularly in the United States, the investment landscape has long been dominated by equities, bonds, and real estate. The mentality has been to chase growth, maximize leverage, and ride bull markets higher and higher. But this approach has led to massive financial imbalances. The Federal Reserve, in an attempt to keep the system functioning, has had to suppress interest rates for decades, artificially inflating the value of financial assets while simultaneously encouraging unsustainable borrowing. When rates rise as they are now, the reality of these distortions becomes apparent, and suddenly liquidity dries up. The days of easy money are numbered. The sheer magnitude of debt that governments around the world have accumulated will likely be one of the primary catalysts for an explosive rise in gold prices. Debt levels in the U.S. have surpassed $34 trillion, and when you account for unfunded liabilities like Social Security and Medicare, the actual figure is well over $100 trillion. There is no realistic way to pay this back. The only options available to the government are defaulting outright, which is politically unfeasible, or inflating the debt away, which means devaluing the currency. This is exactly why gold will continue to rise. When fiat money loses credibility, real money, gold and silver, asserts its dominance. A major issue that few investors seem to recognize is the declining liquidity of financial markets. In the past, treasury bonds were considered the safest asset to hold because they provided a risk-free return. But with the Federal Reserve aggressively printing money and manipulating interest rates, confidence in treasuries is waning. The market is beginning to realize that holding U.S. debt means exposure to an asset that loses purchasing power every year. Central banks, particularly in China and Russia, understand this predicament better than most. Over the last decade, they have been aggressively accumulating gold while simultaneously reducing their exposure to U.S. treasuries. China's gold reserves are likely much higher than officially reported. While the People's Bank of China has disclosed holdings of around 2,300 metric tons, many analysts believe the real figure is closer to 20,000 metric tons. The Chinese government has been strategically accumulating gold through multiple channels, including purchases by state-owned banks, direct imports, and domestic production. Russia, similarly, has quadrupled its gold reserves in the last 15 years. With sanctions cutting it off from the global financial system, Russia has turned to gold as a key strategic asset. When the West froze Russia's foreign reserves in 2022, it sent a clear message to other nations. If your reserves are held in US dollars or euros, they can be taken from you at any time. This has accelerated the global de-dollarization trend, with more countries moving to settle trade in local currencies and gold. At the moment, gold remains heavily underowned. Less than 0.5% of total global investment capital is allocated to gold and silver. This is an astonishingly small fraction, considering that gold has historically represented a much larger portion of global wealth. During past financial crises, such as the 1970s inflationary crisis and the 2008 financial collapse, gold experienced massive inflows as investors sought safety. If gold were to return to just its historical 2% allocation in global portfolios, demand would quadruple overnight, sending prices skyrocketing. Silver, often referred to as gold on steroids, has even greater potential. The gold-to-silver ratio currently sits at around 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historically, this ratio has been much lower, averaging around 16 to 1 during periods when silver was actively used as money. If the gold price rises, silver will rise even faster, as it has in previous bull markets.
Tariffs for sure will go dollar for dollar. So if Trump imposes 25% tariffs on gold, any gold coming into this country is going to be marked up by $25. Otherwise, it won't come in because nobody in Russia is going to sell gold to America for $1 less than they can sell it in Europe, right? The price is the price. And so if we want to tax Americans $25 to buy Russian gold, then they're going to pay $25, 25% more than what the Europeans are paying for the same gold. So the idea is to buy it now. And the same would be true with silver. Now, I guess if you're buying like junk silver, obviously that's not imported, but that's, when you're buying junk silver, that's a used product, right? By definition, right? You're buying it from somebody who's selling it. But if there's a 25% tariff on silver coming in, that's going to cause a big premium in junk silver, because people buying junk silver, or anybody who's buying, a used silver product that's already in this country, right? They're going to be able to charge more because it's not going to be competing with the new products that are being imported into the country. So the big guys, the institutions, are trying to jump ahead and they're buying their metal now. I would suggest that, my followers, customers, Schiff Gold, do the same thing, except more so with silver, right? Buy your silver now. Maybe there'll never be tariff. Well, it's still cheap. You should buy it anyway. Even if you didn't have the threat of tariffs that were going to make physical gold and silver a lot more expensive, you'd want to buy it anyway. So now you got another reason, right? You can kill two birds with one stone. You can get into silver before the price goes up, and you can beat the tariffs. And if it turns out there are never tariffs, well, then you still did the right thing by buying it. And the fact that we did get this sell-off, it may have been off to the races on Friday. After it was up $1, maybe it would have got up 2 or 3, and who knows? The fact that it came down, that's a good thing if you want to buy some silver.
As gold and silver prices continue to move, investors are trying to decipher the long-term implications of the market trends, especially in the face of possible tariffs and shifting global economic policies. The surge in silver prices on Friday morning had sparked excitement among investors, but the sudden pullback later in the day brought in some hesitation. Yet what remains clear is that silver's long-term trajectory looks incredibly strong. Historically, silver has always had a closer correlation with gold, and while gold has already surged past several key resistance levels, silver remains relatively undervalued. The gold-to-silver ratio, which has historically hovered around 50-to-1 in bull markets, remains significantly elevated at over 90-to-1, indicating that silver is still massively underpriced. If history repeats itself, and it often does in commodity cycles, silver has a lot of catching up to do, and this catch-up phase could be dramatic. We've seen silver behave in this way in previous bull runs. During the 1970s gold boom, silver lagged for much of the rally before suddenly exploding in value, rising over 800% in just a few years. The same thing happened during the 2000s bull market, when gold steadily rose while silver remained suppressed, until it wasn't. Once silver broke out in 2010, it ran from under $20 to nearly $50 an ounce in just a few months. The setup today looks eerily similar. Gold is already making new all-time highs and pushing toward the psychologically significant $3,000 level. Silver, meanwhile, is still far below its previous highs, and yet is seeing significant accumulation from both institutional investors and central banks. The moment silver crosses certain resistance levels and institutions realize that they are underweight in this critical metal, we could see a flood of capital move in, causing prices to skyrocket. One of the main drivers behind this trend is the Federal Reserve's monetary policy and inflation expectations. Despite their public stance of fighting inflation, the Federal Reserve has painted itself into a corner. The U.S. economy is drowning in debt, with deficits continuing to spiral out of control. Interest payments on the national debt have surged past $1 trillion annually, and the government is being forced to roll over debt at significantly higher interest rates. This is unsustainable. Either the Federal Reserve will be forced to continue rate hikes, which would eventually crush the economy, or they will reverse course and return to easing policies, which would devalue the dollar even further. Historically, every time the Federal Reserve has faced this type of dilemma, they have chosen inflation over austerity. That means gold and silver will continue to rise because they are not just commodities. They are real money, assets that cannot be printed out of thin air. Another factor supporting silver's rise is the industrial demand that is growing exponentially. Unlike gold, which is primarily used as a store of value, silver has significant industrial applications. With the green energy movement gaining momentum, silver is becoming an essential component in solar panels, electric vehicles, and other high-tech applications. The global push toward clean energy and the electrification of the transportation sector will continue to drive silver demand higher for years to come. The mining sector, however, is not keeping up. Silver production has remained relatively stagnant, and many primary silver miners are struggling to maintain output levels. This is a classic supply and demand imbalance that will eventually force prices much higher. Furthermore, geopolitical tensions and de-dollarization efforts among major economies are adding additional tailwinds for gold and silver. China and Russia have been steadily increasing their gold reserves while simultaneously reducing their exposure to U.S. treasuries. This trend is accelerating as more countries seek to reduce their reliance on the dollar in international trade. The introduction of BRICS-backed financial systems and alternative payment structures is another sign that the global financial system is shifting away from a unipolar U.S.-dominated model to a multipolar one. These moves signal a loss of confidence in the dollar and traditional Western financial instruments. Central banks recognize that gold and silver are the ultimate safe haven assets in times of currency uncertainty, and they are acting accordingly. There's also a broader shift happening in the gold and silver markets, one that suggests we are in the early stages of a major price revaluation. For years, Western central banks and financial institutions have worked to suppress gold and silver prices through paper derivatives trading. The London Bullion Market Association, LBMA, and COMEX have operated as mechanisms to manage the price of precious metals through excessive short positions in leveraged futures contracts. However, this scheme is unraveling. The East, led by China and Russia, is now increasingly setting the price of gold through physical demand. The Shanghai Gold Exchange has become one of the most important pricing hubs in the world, and it operates differently than Western exchanges. In Shanghai, gold is settled in physical delivery, not just paper contracts. This means that demand is exerting real pressure on supply, unlike the synthetic manipulation we've seen in Western markets for decades. As more investors awaken to the fact that the real price of gold and silver is determined by physical supply and demand rather than paper contracts, the traditional COMEX and LBMA systems will lose their grip on price suppression. When that happens, gold and silver prices will be free to reflect their true value. This could mean gold reaching $5,000, $10,000, or even higher in the years ahead. Silver, given its much smaller market size, could see an even more explosive move. A return to a gold-to-silver ratio of 50-to-1, for instance, would mean that if gold reaches $5,000, silver should be at $100 an ounce. If gold reaches $10,000, silver should be at $200 an ounce. These are not wild predictions. They are based on historical relationships and market cycles that have played out multiple times in the past. One of the most overlooked aspects of silver is its increasing role in monetary reserves. While gold has long been held by central banks, silver has been largely ignored until now. Several countries are now exploring the idea of adding silver to their strategic reserves. If we start seeing central banks buying silver the way they buy gold, it will be a game changer for the market. The available supply of above-ground silver is extremely limited compared to gold, and any substantial accumulation by governments or large institutions could push prices significantly higher in a very short period. As we move further into 2025, the need for real assets has never been greater. The Federal Reserve's credibility is eroding. The government's fiscal position is unsustainable. Geopolitical tensions are increasing, and the global monetary system is shifting toward a multipolar world where gold and silver play a far more significant role. This is why the smartest investors, those who understand history and economic cycles, are not waiting for official confirmation of a crisis. They are taking action now, accumulating precious metals while they are still affordable. Gold and silver are not just speculative investments. They are insurance against the failure of fiat currency systems. When you own physical metals, you are not relying on the promises of politicians or central bankers. You are holding an asset that has maintained its value for thousands of years. No matter what happens in the economy, no matter how much the dollar depreciates, gold and silver will always hold purchasing power. For those who have been hesitant to enter the market, the window of opportunity is closing. Once silver starts its breakout move above $50 an ounce, it will be difficult to find physical metal at reasonable prices. We are already seeing shortages in certain bullion products, and premiums on physical silver have been rising. This is a telltale sign that demand is outpacing supply. The next phase of this bull market will likely be marked by rapid price moves and increasing difficulty in acquiring physical metal. In summary, all the signs are pointing toward much higher prices for gold and silver. Inflation is persistent, central banks are accumulating metals, geopolitical risks are rising, and the monetary system is shifting. Investors who act now will be well positioned for the next leg of this historic bull market. Those who wait risk paying much higher prices or being unable to secure physical metal at all. The time to buy is before the breakout, not after.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.